Imagine you owe more money than you will ever earn in your lifetime. Not a little more, a lot more. Now imagine that the people you owe it to keep lending you even more, every single year, without question, without panic, without consequence. You would call that person insane, or desperate, or both. But what if the borrower was not a person? What if it was a country? Right now, the United States owes over $34 trillion. The UK owes more than its entire economy produces in a year. Japan owes more than twice what its entire economy produces. And every single one of those countries will borrow more this year than they did last year. Nobody is cutting them off. Nobody is sending a collections notice. The loans keep coming. If you missed 3 credit card payments, your interest rate would double and your score would crater. If you missed a mortgage payment, the clock on losing your home would start ticking. So why do governments get to live by completely different rules? The answer is not what most people think. It is not just about trust. It is not just about power. It is about something much stranger, something that was quietly built into the architecture of modern money itself. And once you see it, you cannot unsee it. Let us start with something simple. When you borrow money, you are borrowing someone else's money. That's the deal. A bank has deposits, you need funds, they lend you theirs, you pay it back with interest. The math has to work. If the debt grows faster than your income, eventually the system breaks. The bank stops lending, the spiral begins. This is how most people intuitively understand debt. It has a ceiling, it has consequences, it ends somewhere. Now here's where governments start to look different. When the United States needs to borrow money, it issues something called a Treasury bond. A bond is essentially an IOU. The government says, give us money today and we will give it back in 10 years with interest. Investors buy those bonds, pension funds, foreign governments, banks, regular people. The government gets the cash, investors get a reliable return. So far this sounds normal. Someone has money, someone needs money, a deal is made. But here's the first strange thing. When those bonds come due, when the 10 years are up and the government has to pay back the money, do you know what it does? It borrows more money to pay back the old money. It issues new bonds to retire old bonds. The debt does not get paid down, it gets rolled over, continuously, almost automatically, and almost nobody in the room thinks this is alarming. Here's why. A government is not like a person or even a company in one very specific and very important way. A government does not retire, it does not die, it does not have a bad decade and give up. In theory, it exists forever. And when something exists forever, the entire concept of long-term debt starts to bend. Think of it this way. If you borrow $100,000 at age 30, a lender needs to believe you can pay it back within your working lifetime. Maybe 30 years, maybe 40. There's a clock on you. But if you're an institution with no end date, the clock works differently. As long as the economy grows, as long as the tax base expands, as long as people believe the government will keep functioning, the debt can theoretically keep growing alongside the economy without ever needing to be extinguished. This is the concept economists call debt sustainability. Not whether the debt can be paid off, but whether it can be managed, whether the interest payments stay affordable, whether the ratio of debt to economic output stays roughly stable. It's less about solvency and more about credibility. And credibility is where things get very interesting. Now we need to talk about something that most debt conversations skip right past: currency. Most governments that get into serious trouble borrow in someone else's currency. Think of a developing nation that borrows in US dollars. It earns revenue in its own currency. If that currency weakens, suddenly the debt becomes far more expensive to service. The numbers spiral. The country can't print dollars. It's stuck. This is how debt crises happen in smaller economies. This is Argentina. This is Sri Lanka. This is the pattern. But the United States borrows in dollars, and it prints dollars. This is not a small detail. This is the entire game. When the US government issues debt, it issues it in a currency that only one institution on Earth can create: its own central bank, the Federal Reserve. Now, this doesn't mean the government just prints money to pay its bills. That's a simplification that causes more confusion than clarity. The relationship between the Treasury and the Federal Reserve is more complicated and more subtle than that. But it does mean that the United States can never technically run out of the thing it owes. It can create more of it. This is a privilege so extraordinary that there's actually a term for it: exorbitant privilege, coined by a French finance minister in the 1960s who was annoyed about exactly this asymmetry. Most countries don't have this. You don't have this. I don't have this. The US does, and to a lesser extent, so do the UK, Japan, and other nations that borrow in currencies they control. But let's not let the government off the hook too quickly here, because while they can't technically default on debt in their own currency, they can do something almost as damaging. They can inflate it away. Here's how that works and why it matters to you directly. If the government owes $1 trillion and then quietly allows inflation to run at 5% for several years, the real value of that debt shrinks. $1 trillion in 10 years of moderate inflation is worth significantly less than $1 trillion today. The number stays the same. The burden quietly erodes. Who pays for that erosion? Anyone holding savings in that currency. Anyone on a fixed income. Anyone whose wages don't keep up. Anyone whose pension was promised in nominal terms. In other words, you. This is the mechanism that sits beneath the surface of monetary policy debates. It's not a conspiracy, it's not secret, it's just underexplained. Governments have a structural incentive to tolerate moderate inflation because inflation is a slow, invisible tax on the value of their debt, and it comes with no vote, no announcement, no press conference. The debt stays manageable, the currency quietly loses ground, and most people never connect the two. Now, let's add another layer, because this gets stranger. You would think that issuing enormous amounts of debt would eventually make investors nervous. More supply of bonds should mean lower prices and higher interest rates. Higher interests make the debt more expensive to service. The system starts to strain. This is the argument made by deficit hawks for decades, and it's been wrong in ways that have embarrassed a lot of very credentialed economists. Japan is the most extreme example. Japan's debt-to-GDP ratio is over 250%. That means the country owes more than 2.5 times the value of its entire annual economic output. By any conventional model, this should have triggered a debt crisis decades ago. Interest rates should have surged, investors should have fled, the yen should have collapsed. None of that happened. Japan has had some of the lowest interest rates on Earth for over 30 years. Why? Because Japanese investors, Japanese institutions, and the Japanese central bank itself absorbed that debt. The government essentially owes a large portion of it to its own people and its own institutions, and those institutions aren't going anywhere. This doesn't mean Japan is fine. It means the timeline of consequence is longer and stranger than anyone expected. The reckoning, if there is one, doesn't look like what we think a reckoning looks like. It looks quieter, slower, a gradual erosion of dynamism, low growth, aging demographics, a society that functions but no longer accelerates. Some economists call this the Japanization of Western economies, and when you look at Europe and increasingly at the United States, the comparison is becoming uncomfortable. So let's zoom out for a moment and hold the full picture. Governments can borrow indefinitely in their own currency because they control that currency, because they never die, because their revenue base is the entire productive output of a nation, and because global investors have, for now, decided that the alternative to holding their debt is worse than the risk of holding it. You can't do any of those things. You don't control the currency you earn. You have a finite working life. Your revenue is your labor alone, and no investor is forced to hold your debt as a global reserve asset. The rules are different because the entities are fundamentally different. This is not hypocrisy. It's not unfairness in the traditional sense. It's a structural asymmetry built into how modern money works. But here's the part that should give you pause. The assumption underneath all of this, the load-bearing wall of the entire structure, is that trust holds, that the world continues to believe the currency is worth holding, that the institutions remain credible, that the political system can make hard decisions when it needs to. And right now, in several major economies simultaneously, that assumption is being tested in ways it hasn't been tested before. Not through a dramatic crash, not through a single moment of rupture, through something slower and more corrosive, the gradual sense that the people running the system are managing short-term politics rather than long-term stability, that the debt is growing because it's building something, because stopping it would require courage that nobody in power currently has. Here's where we land.
Governments can borrow indefinitely until they can't, and the shift from one state to another doesn't always come with a warning. It comes when confidence moves, when enough people in enough rooms at the same moment decide the math no longer holds, when the bond market stops being polite. It happened to Greece, it happened to Argentina, it happened to Weimar Germany in the most catastrophic version of the story. It hasn't happened to the United States. Not yet. The dollar is still the world's reserve currency. The Treasury market is still the deepest and most liquid in the world. The system still functions. But the margin of credibility is not infinite.